When it comes to investing, the landscape is as varied as it is volatile. From the cryptocurrencies that dazzle with their digital promise to the age-old reliability of stocks and real estate, each sector offers unique challenges and opportunities. This essay is your compass in the tumultuous world of investing, drawing on the wisdom of the top 100 best investors across time. These titans of finance didn't just survive, they thrived, bending market forces with a blend of sharp insight and unerring strategy. By delving into their secrets, we can uncover not just how to survive, but how to thrive in the markets of tomorrow. Join us as we explore these fascinating strategies, from the traditional to the cutting edge, and learn how to see through the eyes of those who have mastered the market. Investing has transformed dramatically from the days of simple barter systems to the complex global financial markets of today. Initially, investing was about finding tangible assets that would appreciate over time. Today, it encompasses a vast array of financial instruments, each with its own risks and rewards. The transition from traditional to digital assets marks one of the most significant shifts in investing history. While real estate and stocks still dominate, the rise of digital currencies and tech-driven investments has opened new frontiers. This part explores how successful investors have adapted to these changes, maintaining relevance and profitability in an ever-evolving financial landscape. Before diving into any investment, understanding the core principles of the market is crucial. Markets are driven by supply and demand dynamics, but they are also deeply influenced by investor psychology and economic indicators. At its core, investing is about allocating resources with the expectation of a future financial return. This involves assessing the risk versus potential reward of any given opportunity. Understanding these dynamics can help investors make more informed decisions. This discussion focuses on the fundamental concepts that underpin all types of investing, whether you're buying stocks, real estate, or venturing into cryptocurrencies. Understanding these basics is the first step toward making wise investment choices.
Value investing is a strategy championed by Benjamin Graham and later popularized by his most famous student, Warren Buffett. It involves identifying stocks that are undervalued by the market but have strong fundamentals and good future prospects. The key here is the concept of intrinsic value, a perception of a stock's true worth that differs from its current market price. Successful value investors buy these stocks at a discount and wait for the market to recognize and correct the undervaluation. This part delves into the techniques used to identify undervalued stocks and discusses several case studies of successful value investors who have amassed fortunes through this disciplined approach.
Growth investing strategies. Whereas value investing looks for stocks that are undervalued, growth investing focuses on companies that offer strong earnings growth potential. Philip Fisher, one of the pioneers of this strategy, advocated investing in companies with promising growth prospects, even if their stocks are not undervalued by the market. Growth investors typically invest in companies that have unique innovations, a competitive edge, or a scalable business model. They look for indicators such as high profit margins and high return on equity as signs of potential. This section explores various growth investing strategies and how they can lead to significant returns if executed correctly. We'll also consider the risks involved, as high growth investing often comes with higher volatility and market expectations.
Real estate investment tactics. Real estate investing can offer both significant returns and stable income, particularly when managed wisely. The first rule in real estate investment is often cited as location, location, location. Investing in the right location can mean the difference between a highly profitable investment and a mediocre one. Beyond location, successful real estate investors often use leveraging to their advantage. By using borrowed capital to increase the potential return of an investment, they can significantly enhance their earnings, though this also increases risk. This part provides practical tips on managing real estate investments, from choosing the right properties to managing them effectively to maximize returns. We'll also explore different types of real estate investments, such as residential, commercial, and REITs, real estate investment trusts.
Cryptocurrency, the new frontier. The rise of cryptocurrency has added a new layer to the investment landscape. Digital currencies like Bitcoin and Ethereum have opened up new opportunities for investors looking for high returns, albeit at a high risk. Investing in cryptocurrencies is not just about buying and holding. Successful crypto investors often engage in a variety of strategies, including trading, mining, and participating in initial coin offerings, ICOs. This section discusses the basics of cryptocurrency investment and outlines strategies that have been used by successful investors in this space. We'll also address the inherent risks and how to mitigate them as much as possible.
Investing in the stock market is one of the most traditional and popular ways to grow wealth. It involves buying shares of public companies, and investors earn returns either through dividends or stock price appreciation. This part focuses on different strategies for stock market investing, from day trading to buy and hold strategies. We'll discuss how legends like Warren Buffett select stocks, focusing on long-term growth and stability rather than short-term gains. Additionally, we'll explore modern approaches to stock market investing, including the use of algorithmic trading and the impact of global economic changes on stock prices.
Hedge funds, often seen as the playground for the rich and sophisticated investors, employ a diverse range of strategies to achieve high returns. These include long-short equity, market neutral, volatility arbitrage, and many others. The goal is often to achieve positive returns regardless of the market environment. Central to hedge fund management is the concept of risk parity, a strategy championed by hedge fund magnate Ray Dalio. This strategy involves balancing the portfolio in such a way that the contributions to risk are equally distributed across various assets. This part provides an overview of how hedge funds operate, the typical strategies they use, and the kind of investors who might consider hedge fund investments as part of their portfolio. Venture capital is a form of private equity investment where investors provide capital to startups with high growth potential in exchange for an equity stake. This form of investing can be highly lucrative, particularly if one invests early in a startup that goes on to become a major player. Investors in this field look for innovation, scalability, and market potential. They also assess the quality of the management team and the uniqueness of the product or service offered by the startup. This section explores how venture capitalists make their investment choices, the risks involved, and the potential rewards. It also discusses how one can get involved in venture capital, whether directly or through funds. Investing in technology and innovation. The technology sector has been a goldmine for investors over the past few decades, with companies like Apple, Amazon, and Google providing extraordinary returns. Investing in technology involves identifying companies that are poised to benefit from technological advancements and increased digitalization. The key to success in tech investing is the ability to spot trends and innovations that are likely to transform industries. This requires a deep understanding of technology and market dynamics. This part discusses strategies for investing in technology and innovation, including direct investment in tech companies, tech-focused mutual funds, and ETFs. We also explore insights from tech pioneers like Steve Jobs and Peter Thiel. Behavioral finance and investor psychology. Behavioral finance studies how psychological influences and biases affect the financial behaviors of investors and financial practitioners. Understanding these can help investors make better decisions and avoid common pitfalls like overtrading or herd behavior. Key concepts in this field include cognitive biases like confirmation bias, overconfidence, and loss aversion. Each of these can skew decision-making processes and lead to suboptimal investment outcomes. This section delves into how understanding investor psychology can improve investment decisions and outlines strategies to mitigate the impact of these psychological biases. Diversification and risk management. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique is that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. This part explains why diversification is considered one of the most important components of reaching long-range financial goals while minimizing risk. We also discuss various ways to diversify investments across different asset classes, sectors, and geographies.
Economic indicators are key stats that indicate the current status of the economy of a specific country. They are important to investors as they signify the economy's direction and have a direct impact on the financial markets. Understanding these indicators, such as GDP growth rates, unemployment rates, and consumer price indices, can help investors predict market trends and make more informed decisions. This section highlights the most important economic indicators for investors and explains how to interpret these indicators to benefit one's investment strategies.
Market volatility is often driven by global events such as geopolitical conflicts, economic crises, or major policy changes. Understanding the impact of these events on investments is crucial for managing risks and safeguarding assets. This part examines case studies of past global events that had significant market impacts, such as the 2008 financial crisis and the COVID-19 pandemic. We discuss strategies for protecting investments during such volatile times and how to position oneself for recovery. Sustainable and ethical investing is an investment discipline that considers environmental, social, and corporate governance (ESG) criteria to generate long-term competitive financial returns and positive societal impact. This trend is growing as more investors seek not only financial returns, but also social good. In this section, we explore the basics of ESG investing, the benefits it offers, and how to incorporate ethical considerations into investment decisions. We also discuss the performance of sustainable investments compared to traditional investments.
In today's digital age, technology plays a crucial role in investing. Automated trading systems, algorithmic trading, and robo-advisors are becoming mainstream tools that help both individual and institutional investors make quicker, more accurate investment decisions. This part discusses the technological advancements that are shaping the investment world, including artificial intelligence and machine learning. We explore how these technologies can be leveraged to gain a competitive edge in the market.
Government policies and regulations can have a profound impact on investment markets. Changes in tax laws, monetary policy, and regulatory frameworks can alter the investment landscape, sometimes radically. This section discusses how investors can stay informed about relevant policy changes and adjust their investment strategies accordingly. We also explore the implications of major policy changes in recent history, such as those related to financial market regulations and corporate taxation. Effective tax planning is essential for maximizing investment returns. Different investment vehicles and strategies can have significant tax implications, affecting overall profitability. In this part, we offer strategies for tax-efficient investing, including the use of tax-advantaged accounts and the timing of buying and selling assets. We also discuss the importance of understanding local and international tax laws when investing globally. The psychology of money goes beyond simple financial decisions. It encompasses our beliefs, emotions, and behaviors related to wealth. This complex relationship can significantly influence how we manage and invest our money. In this section, we delve into the psychological aspects of dealing with large amounts of money and how it affects individuals' lives and investment choices. We discuss strategies for managing the psychological pressures associated with wealth. Learning from experienced investors can accelerate one's understanding and success in the investment world. Mentorship provides insights that are not readily available through books or courses. This part discusses the importance of finding and choosing the right mentors in the world of investing. We highlight how mentorship can provide practical, real-world advice and guidance, helping to navigate the complexities of various investment landscapes. The investment landscape is continually evolving, influenced by changes in technology, global economics, and societal values. Staying informed about these changes is crucial for any investor looking to stay ahead. This concluding section offers predictions for the future of investing and discusses how investors can prepare for and adapt to these changes. We explore emerging trends such as the increasing importance of sustainability and the growing influence of digital currencies and blockchain technology.